Hello, good morning. Good to see you all. All right, so my co-founders and I we did two companies before. Both of them were venture funded, both of them were acquired. When we started Backblaze, we said, you know what, there are some good parts about venture funding, there's some bad parts, let's do it differently. So we started by bootstrapping, we quit our jobs, we said for 1 year we're gonna do nothing in terms of venture funding. There's going to be no PowerPoints, there's going to be no spreadsheets, there's going to be no pitches, just focus on product, focus on customers, see how it goes. So we did that for 15 years. We took the company public in 2021. I'm going to try to share 15 years worth of history in 20 minutes or less here. So this is what it started like. Probably what a lot of you guys started like, right? Five guys, you know, 1-bedroom apartment. The tall guy standing in the room there in the blue shirt, that's his 1-bedroom apartment. He's living in the 1-bedroom that's behind the wall over there. All of us are crowded in. The reason I'm wearing flip-flops and a t-shirt is because it's hot as hell because there was no AC and we didn't have enough power to power the servers and the AC at the same time. So this is how it started. And then in 2021, we were able to bring about a third of the team out to New York, out from San Francisco, to ring the bell on the NASDAQ in Times Square. Really exciting day, super fun, you know, the whole shindig. So, you know, when we started the company, we said, hey, you know, what are we going to do? We're going to run this forever as a private company? Are we going to raise funding? Are we going to sell the company like we did the last two? Are we going to take it public? And taking it public was one of the possibilities, but it was a little bit like trying on, you know, your dad's pants when you're a kid. You know, sure, yeah, maybe someday we'll fit into these, right? It was, you know, it was still kind of a fiction, right? And so I'm going to share what kind of some of the learnings, both in terms of what it took to go public, as well as why bootstrapping is actually a good way to get to be able to go public. But one of I think the things I want you to walk away with is it's possible to go public, right? And I think for you know, at different stages, it doesn't feel that possible, right? Okay, so you know, we're going to talk about how you decide, how do you prepare, how do you actually execute on that process. This was our path to there revenue-wise. And so, you know, if you look over here, let's say, you know, 2014, we were at about $10 million in revenue. You know, many of you are probably, you know, many of you are beyond this, some of you are beyond this, some of you are at the beginning of this, some of you are in the middle. But, you know, sitting in 2014 with $10 million of revenue, you know, kind of going like, oh yeah, maybe we'll take the company public, still seems like a fiction. But then you look at it, it's only 7 years later and, you know, 8 years later and we're public, right? So, you know, the thing to walk away with here is, you know, like at the beginning, it's like, you know, you're just trying to figure it out. And, you know, I loved the first speaker who was talking about, you know, getting to 50K of MRR. Like, it's awesome. And it, you know, at that kind of growth rate, it's only a number of years before being public is actually a feasible path. Okay, so what do? We started off selling computer backup, so you know, backing up your laptops and desktops, $7 a month, totally unlimited. We do that for individuals, we do that for businesses. It's super simple and it takes care of everything. Bunch of our customers started coming to us and say, hey, I love you for your backup service, and I trust you for all my storage stuff, but I need all these other storage things. Give me access to your platform. So, you know, listening to customers, hearing what they wanted, we built B2, which was our second offering. It's cloud storage as a service. It's like Amazon's S3 service for object storage, but it's 1/5 the price point. So if you're using Amazon S3 and you want to save a whole bunch of money, make it easier, you know, come check out B2. So deciding. I think it's generally there's a belief that if you're going to go public, you have to raise money and you have to raise a ton of money because you have to burn a ton of money because that's the only way to go public. It's a contrarian viewpoint, but I think bootstrapping is actually in many ways a better way to get to be a public company. Here's some of the ways that I think it helped us. When we started the company, we were going to use Amazon S3 as the underlying way that for the infrastructure for our cloud backup service. That's what we wanted to do. We did the math and we said, oh, we're going to lose money on every customer. That didn't seem like a good way to build a business. If we had raised a whole bunch of venture funding, we probably would have done it and said, we'll figure it out later. Somehow we'll figure out how to make the math work. But we didn't have any money. So we had to start from first principles and figure out how to actually make the business work. We ended up designing a platform that was like drastically less expensive than Amazon, which we probably would have never done if we had 10 million bucks of cash in the bank on the first day. It also just continued making us efficient throughout the years. Every single day, the culture was built up that you have to focus on the efficiency of building the business. That is a fundamental thing that comes with bootstrapping. It also, I think, drives your go-to-market approach. For us, we couldn't spend money on ads. We didn't have any money, so we built a really efficient go-to-market, which was self-service and PLG-based, and we started writing a blog that was focused on storage and had about 3 million people a year that started reading it. That drove a lot of people to come and check out the company. It didn't really cost a lot of money because we didn't have a lot of money. So I think bootstrapping has lots of advantages that actually help you build a business, and especially in today's environment where companies care about profitability and EBITDA margins and cash flow in the public markets. It's a value, and it's hard to build that value after you've raised tons of money for years and years and years to change the culture to do that. So, and this is kind of the last one, which is like that whole culture of establishing a bootstrapped is part of that. Okay. So those are some of the advantages, I think, of building Bootstrapped as a path to going public. Now, on the comment of the when do you actually go? So what all of the experts that we spoke with said was, you've got to wait until at minimum you're 100 million in revenue, and really you should be at 300 million because that's the size companies that go public. And they're right. That's the average size of company that goes public. You know why? Because the banks make more money that way. But when we went public, this was the chart that we went out on the roadshow with. A few different numbers on there, but focus on the one that says 65 million of ARR. It was not 300. We still went public. You can take the companies public at smaller scales than the banks are leaning into taking companies public because they make a fee on the amount that you raise. Okay. So what about in terms of costs? So it is expensive to go public. So we talk about Backblaze cloud storage, really easy, really inexpensive. Going IPO, not easy, not inexpensive, but it is possible. So it cost us $10 to $15 million to take the company public. Kind of a big number. Most of that went to the banks because they take 7% of what you raised, but there are lots of other places where you actually have to spend money. Lawyers, accountants, directorate office insurance, there's a whole bunch of stuff. So it's expensive, but if you're raising 100 million and you give away 10 million, it's a little bit of the cost of doing business. Okay. When do you do it? So part of the thing is that when you're actually going public, it's when you're going to be talking to investors about, if you give us money, we're going to do the following things with it. So you need to have metrics and a story around this is the right time for you to change that trajectory. For us, it was because B2 cloud storage was growing really fast, and there was this big market for it, and everybody we had lots of people that were switching off of Amazon Web Services and coming to B2, and we were talking to investors about that. They saw that growth, and they said, yep, that makes sense. So thinking about the kind of the story, timing, and the metrics, but you got to start early because it still takes often like 2 years to actually get ready. Okay, preparing. So how do you actually do the preparing part of it? So first of all, you have to reframe the story, but not rewrite the story. So one of the things that will happen is when you start down this path, there's a whole machine, bankers and everybody else, that want you to tell a different story than the one that your company actually is. They want you to be a different company because it looks better on a spreadsheet or it looks better in a pitch. You want to reframe your story because you're speaking to a different audience. You're not speaking to your customers, you're speaking to investors, but it still has to be the real company. It's the company that you built. So if you have a ton of upsell, then talk about the amazing ways you upsell. If you don't have a ton of upsell because most of your business is selling to new customers, talk about how you get new customers. Don't tout how you have tons of upsell. Focus on kind of like what is it that makes your company special. Don't fit into the rubric that the bankers and everybody else are going to push you into. So this is a smidge from our S1. This is kind of the left is the starting bits of the outline, and then that's one of the first pages on it. The team. So this is probably the part that everybody's most set up for, right? Which is make sure that your team itself running the business is prepared and ready to actually go down this path. It's going to be distracting. It's going to take a lot of time. It's not just a finance and accounting thing. That was one of the mistakes we made. We said, oh, we think this is really going to be mostly about the finance and accounting teams, but it actually does suck up a lot of the rest of the company to get involved in the whole IPO process. Know that up front. Make sure your team is ready for that. Finance. This is on the left, the little two boxes. That's what our finance team looked like before we started down the path. On the right, that's what our finance team looked after the path. Finance is kind of an important part of going public. It takes a lot of people. You have to have a whole structure, processes, systems. People don't think you're going to go public with a part-time CFO. The other part, the syndicate, the banks. So there's a whole art and science of picking the banks that take you public. You hear about Goldman Sachs and JP Morgan. Those are appropriate potentially if you are going out and raising $1 billion in capital. If you are, 50, 60, $100 million in revenue and you're raising $100 million, those banks are going to give you the C team if you go with them, and they will drop you in a second if they have a different opportunity. They're not the right fit. So you have to find the right banks. These are the actual banks in the ordering and everything. There's a whole ton of crazy stories around how you pick the banks, but the one thing I'll leave you with is, I didn't make this quote up, somebody else did, but it resonated with me, which is you date your banker, you marry your analyst. So the bankers, they drop in, they take you public, they leave. The analysts at these banking firms are who are hopefully going to be with you quarter after quarter after quarter after quarter. And so when you're picking your banks, you're actually picking your analyst. So start by looking at the analyst, then pick the banks. Okay, other things, building teams. So the board, we had 5 founders. The 5 founders were the board members for 12 years with me. When you go public, you have to have an independent board. The insiders are not independent. So you have to recruit new people who are going to be your independent board members. Lots of interesting tidbits about how you pick board members. One thing that I'll share with you is I had a friend who said, "Oh, I know this board member who's a board member of Google. Do you want an intro?" And I was like, "Yeah, that sounds amazing to get a board member from Google." And then what I realized, talking to some people who've gone through the experiences, that's not who you want. Because if they're the board member of Google, how much time and focus are they going to give you as a board member of your company, right? So you want board members who are really going to be deeply invested and care about you and your success and become prepared and everything else. So pick those kind of board members. Okay, the rest of the team. You need auditors, lawyers. As part of it, we picked BDO. One of the things I learned is we had an auditing firm. You know what? You can't have just any auditing firm when you go public. You have to have a PCAOB auditing firm. There are only certain auditing firms that do that. So you have to pick one. Gunderson Detmer was our lawyers. Loved them. They did a great job with us. Certain lawyers have gone through the process of taking companies public. They have to have done that for this part of it. I also really loved Third Creek Advisors. Adam, he's an IPO advisor. He helped us learn a lot of this stuff. He was awesome. I totally recommend him if you're going down this process. Okay, so that's the team, right? So the inside team, the bankers, the lawyers, the accountants, and et cetera. Building resilience. So like everything, and like many of you probably experience day to day, something goes wrong all the time, right? In our case, a few of the things that went wrong. The syndicate of banks collapsed. We had to redo the syndicate. We had a key board member that had to leave during the IPO process. One of our key partners who was involved in our IPO roadshow launched a competitor like a week before we were going public. Like, wait, what? The SEC, the person who was in charge of reviewing our S1 document, after years and years and years at the SEC, leaves, right, and retires midway from the SEC during the process. Disappearing banks. No, this is not SVB. This was, a couple years ago. One of our banks decided midway through the process, you know what, we don't want to be in technology anymore. We're getting out of the tech space. What? Stuff's going to come up. You have to keep kind of plowing forward. Okay, executing. So the actual process. You've got your S1, you've reframed your story, you've got your team, you've got your banks, you've got all that. testing the waters. In 2012, the Jobs Act allowed companies to file confidentially and talk to investors about the process of going public. Yay! So the bank said, hey, this is testing the waters, you're just kind of getting feedback and everything else. Bullshit. The testing the waters, you're talking to investors, and when you talk to the investors, if those investors don't come back and tell the banks, hey, we're really excited about investing in this, the banks go, I don't think that there's an IPO here to be done. So you're not just getting feedback. This is a real trial run, kind of like the last speaker said about whenever you're talking to VCs, it's not just coffee. Same thing with this process. The roadshow itself. So this is a screenshot of the S1. Most of the pages, not all of them. The key thing with the roadshow is you've got to convert this, 150 pages of S1 document is something that is a compelling story and that you can tell to investors in something like 20 to 30 minutes. It's like a lot of other pitches. You have to convince them that the money they're going to give you means you're going to grow and perform faster. One of the differences potentially is that that story they're going to follow up on every single quarter and go, hey, you told me this story. How's it going? Okay. Then you get to ring the bell. Woo! By the way, it's really fun. In Times Square, you get to actually boink the button. I don't think it's actually connected to anything, but it's fun. They have the whole pop thing and everything. I'm pretty sure it's not connected to anything because if it were, then if you missed the button, which you do practice, by the way, the market wouldn't close on time, and that's probably not what they're going to let happen. But there's a whole process in picking. The day of the roadshow, the day after the roadshow, you have to decide who are you actually going to sell your shares to. So you've gone out, you've pitched a whole ton of investors. Some subset of them have said, yes, I'm interested, I would like the following allocation, and there's a whole art and science around. These investors have said, I want $20 million, and these investors have said, I want $5 million. Do you give them 5? Do you give them 20? Do you give these 5? Do you give these $1 million? Something that was non-intuitive is you want some of the investors who are absolutely going to hold for the long term, but you want some investors who are absolutely not going to hold for the long term. And part of the reason you don't want them to hold for the long term is if all of your investors held for the long term, there are no shares on the market, no volume, no trading. So you actually want a mix of types of investors. Okay. So yay, we went public. You know what happened the day after we went public? The market exploded and everything went to shit. So you have to get ready for the fact that the market conditions change. And when we were on the roadshow, every single solitary conversation was, hey, how can you spend more money to grow faster? That was the only thing anybody cared about. Our very first earnings call, which was like 2 months later, nobody was asking that. You know what everybody was asking? How can you spend less money so that you can get to cash flow break even faster? Right? You're still building the company, so you got to just kind of focus and make sure that you're continuing to execute on whatever makes sense for your company, being careful not to get too swayed in any direction by what's happening in the public markets. So for us, what that meant was, just continuing to focus on, we've got this computer backup business, we're going to continue to sell cloud backup, we've got this B2 business, we're going to continue to focus on cloud storage. One of the things that changed was, we leaned into the fact that a lot of customers started saying, how can we save money off of our existing infrastructure? And we were like, hey, you know what? B2 is a great way to do that, and that's how we can continue to execute into that. Okay, so I think that was 18 and a half minutes of 15 years going from bootstrapping to IPO. So talking a little bit about why you can bootstrap, why that's a good path to IPO, which most of the banks will be like, no, you have to raise money. How you prepare for it, how you execute on the IPO. Obviously, there's lots and lots of stuff behind here. I'm starting to write little blog posts on our backblaze.com/blog, going into more detail on each of these things. So if you're interested in these paths, come check out our blog on the various pieces. All right. I'm going to be here for the rest of the day. Happy to answer questions and anything I can. Thank you, guys.